So this is best practices accounting for small businesses. We really have 4 primary topics that we're going to touch on, but then wanted to leave some room to dive into any of these that kind of fit your needs, your questions, where you are in your various roles and industries. But high level, choosing the best entity type for your business, accounting, bookkeeping, record keeping that Linda's going to cover, and then some tax topics and considerations, as well as audit and other attest requirements that hopefully not too many of you are into that world right now, but if you are, happy to answer those questions. So kind of right off the bat, small businesses of any type, you have to figure out who you are, what you want to be, and that kind of starts with how to establish your legal corporate entity. Now, a lot of small businesses, if you are just getting started on your own, maybe call it even a side business, it's probably just going to flow through on your personal tax return. You don't have to do anything. You don't have to file anything. If you have any sort of side income, side business that you've started informally, it is just a personal business to you. If you do want to formalize this business for all kinds of different reasons, these are really your primary options. So from a tax perspective, you can be a sole proprietorship, so single owner by yourself. A partnership, if you go into business, if you do anything with a partner or partners more than yourself, the IRS views you as a partnership if you have officially legally established yourself as a partnership or not. If more than one person joins together for profit purposes of we're going to do this, sell this with the goal of making money, you have a partnership with that person. And your partnership is very loosely based. It's informal, but y'all have agreed to do this together. You have a joint venture with someone else. It is loosely called a partnership, and you're going to be required to report it as a partnership if you have legally filed and incorporated that partnership or not. For various tax legal purposes, you are a partnership, and your partnership is going to be 50-50. If it's you and another person, you share everything 50-50, contributions to it, expenses, distributions, unless you do officially set up that partnership and you have a partnership agreement that everyone signs and says, no, we're going to share in income this way, expenses this way, we're going to do it a little different, or you legally set up that entity. But even if you don't, just know if you and someone else start a business, you're in a partnership together, and the IRS requires you to file a partnership tax return like you are an official business. If you're just on your own, sole proprietorship, if you have more than one person, you kind of default to a partnership. And these letters, LP, LLP, GP, so they're the various types of partnerships, a limited partnership, limited liability partnership, and general partnership for tax purposes. Corporations, everyone knows your corporations. These are the biggest companies in the world we know of. It's your Exxons, your Coca-Cola, Google, Apple. They're going to be corporations. And when you start thinking about what type of business am I starting and what do I want to be, you're really considering what are, one, my tax consequences, but also what do I care about from a legal liability standpoint? That's really your 2 main considerations when you want to figure out, what do I want to establish here? Is it just me on my own and I'm making a little bit of money and I have this side business? Great. But if you're going to do anything beyond that, you start thinking about, okay, what is my legal liability? Could anyone get injured or otherwise sue me and my business? And do I want to protect that business and the business assets from my personal income and assets? Because when it all gets commingled, if you don't go through that step of setting up a legal entity and it's you, it's all you. It's all your personal assets. It's your house you own personally. I mean, y'all are kind of shaking your head like, yeah, we know that scares us, but we don't want to do that. So that's why we start thinking, okay, now I have this business, it's growing, I'm making some money. What are my risks here? So if you're a realtor, a lot of realtors are on their own. They're just getting a 1099, which really separates you from a W-2 employee of a business. When you get a 1099, you got to figure out, what do I have? I have a business of some sort. Is it just going to be a personal sole proprietorship? I'm the single owner and I got to report this 1099 on my personal tax return and it's just a Schedule C. Great. A lot of people do that, but you have no protection here at that point. So anything you do in that business, it all gets commingled with your personal assets, and if anything happened, unfortunately, you would be liable. So that's why we really sit down and we recommend, all right, let's see what you're trying to do with this business, how far you're trying to grow it, and what can we do to help you set that up to provide some tax advantages, but also some legal liability protection as well. So the partnerships, that's why they have the different LPs, GPs. A general partnership, you don't really have any liability protection. Limited partnerships do. So with a lot of partnerships that have established themselves as an official legal partnership, they actually have both. They have the general partner that is liable for everything, and then the limited partners or limited liability partnership that's not, and it's just they're stuck within that business and those business assets. Your corporations, that's not going to be a lot of groups in this room. I mean, corporations are normally really big companies. A corporation can be an S corporation, which is just a flow-through entity, and this is a tax distinction. So we have a lot of S corps, and if you are an S corp, it flows through to you like a partnership. If you're a C corp, that's the really big businesses I mentioned earlier that you can go out and typically find on the stock exchange, purchase shares in their company. As a C corporation, that is its own tax-paying entity. Nothing inherently flows through to the owners, to the shareholders of that corporation, unless there are distributions, earnings that get sent down. So when you start thinking about, I have a business, I really want it to be a C corporation because I don't want to pay tax at the personal level, I want the business to pay tax. That's great, but we got to think, well, how does that money get then from the business to me as the owners? So that only works if you don't take any money out of it. But if you're a sole proprietor in a business, but you wanted to incorporate it as a C corporation for tax planning purposes, because you think, oh, I'm just going to pay taxes in the corporation and not have to pay tax personally, that doesn't work if you're relying on that as your paycheck, as your only source of income. So if you need money to live on, it's got to get to you somehow, and it's going to come to you from that corporation that has already paid tax at the corporate rate down to you, and you're going to pay tax on it again. So it kind of all ends up being the same. I know a couple of years ago, back in 2017, we had these sweeping tax law changes that they changed all the rates. Some went up, some went down. The corporate rates went way down to the lowest level they've been in a long, long time, like 21%. And there was this rush for everyone to convert their C corporation or their S corporations to C corporations. Say, I want to get out of that S corp because that's just flowing to me. I want to get to the C corporation for tax purposes. We had to kind of graph that out for them and show them, like, well, that's okay in certain situations, but if the money is flowing through to you, you're going to pay tax on it twice, and at the end of the day, it's kind of the same rate. It's just when and where do you want to pay that money. If you're a single owner or partnership, so that's just going on your personal return, or if you're a partnership, you may have to file a personal partnership tax return for that business. There is something called self-employment tax, which everyone in this room, if you have your own business, you know self-employment tax. So that is really the burden against self-employed individuals, is you have to pay that self-employment tax. So in addition to your regular tax, you're going to pay an additional 7.5% to 15% of self-employment tax. And that's the portion that your company pays for you. If you're employed, like we are, if you get a paycheck from your company, your employer is paying half of your payroll taxes, half of your FICA, Social Security, those payroll taxes that come out of your paycheck every time, your employer is paying half. When you're self-employed, you pay both sides. No longer is your employer paying half, so you're having to pay those payroll taxes in. C corporations, you're going to get taxed twice eventually. LLCs, there's a lot of misinformation about LLCs. I mean, I get the question all the time, like, hey, I need to set up an LLC, or we ask, what type of tax entity are you? Oh, I'm an LLC. Like, well, an LLC is great. An LLC is a limited liability company. It's not a taxable entity. An LLC does not tell me how you are taxed. All it tells me is that you went to the state and you set up a business as a limited liability company for liability protection. This doesn't tell me how you are taxed. So an LLC can be a whole bunch of different things. An LLC can be any of these things up above. A lot of single owners also have their business set up as an LLC because that's how they protect them as a single owner, is they're going to put their business inside an LLC, a limited liability company. But an LLC in itself is not a taxable entity per se. It's only a liability protection. And an LLC can be a sole provider, it can be a partnership, it can be a corporation, it can be a lot of different things. We get that question a lot. It's like, hey, I want to set up an LLC for tax purposes. Like, well, your LLC can be taxed any way you want it to be taxed. You're really setting up an LLC for liability purposes with the state to incorporate your business. So LLCs, they can be single member, they can be multi-member, defaults to a partnership, single member defaults to Schedule C, or it can be elected to be treated as an S Corp or C Corp. So any of the above with an LLC there.
Yeah.
Yes. Yeah, and please, questions, raise your hand all throughout. I mean, we want to talk and figure out what questions y'all have.
All the letters mean
There's a lot of letters.
something.
Yes.
What does the S and the C really mean? Does it have any meaning? All the others have.
Yeah. I mean, we really view it as a C as a corporation and an S to us. And I don't know if S means shareholder or sole provider, but an S kind of defaults to a partnership. So in our mind, I mean, C tells us this is a tax-paying corporation. It is a C Corp, like we think of those really big businesses. We can, though, elect to have our corporation be taxed as an S. So it's all corporation. A corporation is a corporation. I mean, nonprofits are nonprofit corporations.
And nonprofits are usually what?
So nonprofits have their own tax rules because they're not a tax-paying entity most of the time. Nonprofits are normally set up as a nonprofit corporation. So you'll see them as a corporation, but they're a specific nonprofit corporation.
It's a different alphabet.
It's a different, yes, different abbreviation there. And once they submit their IRS letter to be tax exempt, we can now receive tax exempt donations from individuals and charities, granting foundations, but nonprofits, they fall into more than anything the corporation. So you can't go and set up a nonprofit personally on your personal tax return. You can't do that. Nonprofits have to be legally incorporated with the state, with the government to be established, and they file their own nonprofit 990 informational tax return. They don't pay tax, it's a tax exempt entity. So really focusing on the taxable ones here, but I know we do have a lot of nonprofits, and I work with a lot of nonprofits, so I love the nonprofit questions, but they typically do not pay tax unless they do have some unrelated business income tax, which does not fall under their tax exempt umbrella that we applied for with the IRS to say, here's our mission, here's our purpose. This checks all the boxes that we need to say, yes, we are a tax exempt entity. We want to be established for this charitable mission or purpose in the community. If they do something outside of that, the government's going to tax them on it. But as long as they're falling under that umbrella of, yes, this goes along with our mission. So a good example of that is a lot of nonprofits will also sell things, and they may set up stores, gift shops. That gets tricky because is my gift shop really sales revenue set up to support my nonprofit? Yes, but is that our nonprofit mission of whatever we're doing? No. There's a lot of views there, and I've seen some of those be challenged by the IRS and lose, and some have been held up, and that really gets into the technical question of, well, if you are setting up a store within your nonprofit that sells goods, merchandise, and really food, if you think a convenience store, well, we can't set up a convenience store as a nonprofit right next to a gas station convenience store, and ours be non-taxable and theirs be taxable. Everyone would just kind of sell and shop over here, and you're competing. So if you're taking business away, if you were set up right next to or close to, you're competing with tax-paying entities that are kind of doing the same thing. The IRS can say, no, like, we're not going to let you do that. That's really a for-profit business. This isn't what you were established to do. A lot of times, though, if you have a retreat center in the middle of nowhere and you set up a shop inside to sell food and drinks, well, that's for the convenience of your guests, convenience of your members, whoever is visiting. You're not competing with anyone. You have this camp retreat center out in the middle of the woods. There's not a convenience store next door that's trying to sell their taxable goods. That's fine, but if it's really set up out there in the public to sell and make money, it's frowned upon. But that's the only way a nonprofit can really fall into the, I have to pay tax now on my unrelated business income that's not under my nonprofit tax exempt mission. Yeah, we don't have a lot of information on nonprofits, but I know when y'all were doing an introduction, there was a lot of nonprofits out here. So feel free to ask any of those questions.
Question.
Yeah.
What's the purpose of filing a DBA versus an LLC?
No purpose at all other than with the bank primarily. So a lot of times the bank will require you, if you've just set up a new business, to open a bank account for that business. They're going to want you to have an EIN. So to get, that's your business social security number essentially. And to get an EIN, you have to apply for one with the state, with the government. They'll assign you an EIN. And then with that, whatever name you set that up, that is your legal entity name. But now you can do business as whatever other name you want to. So you can file a DBA of this is our legal name, but we do business as this. That's really more for the bank's information of how do we keep stuff straight. DBA doesn't do a whole lot. I think there is a box on a tax return if you can tell the IRS like, hey, this is our legal name that you know. We also do business under this name because you may end up getting important documents under both and they just want to keep it straight. But it's really that EIN, your business employer number, your kind of social security number of your business that's more important. That drives everything. Ew. Questions are good. No more questions right now? Yeah, and I kind of covered a lot of this, but these are just the questions of why it's important to consider these different entity types for both tax and liability purposes. And it really depends on how many owners do I have? Well, if I have more than one, I can't be a sole proprietor because that's really just me. If I have a lot, well, a partnership may get kind of complex, especially if we're going to have new people enter and leave all the time. So the number of owners, partners involved in the business may drive you one direction. The type of owners, are people going to contribute capital or are they just going to be sharing in income and expenses? And then if you need any sort of special allocations of, well, we're going to send this type of income to this person, this type of expense to this person. There's certain businesses that work better than others. They all offer some type of different and better liability protection. And really it comes down to what type of business do you have? There's going to be something that works better or that's kind of the norm for your type of business. So a lot of real estate professionals, they may fall in one way. A lot of landmen who are independent, they may fall another way. One thing that we've always kind of sent people away from is holding real estate. So if you're going to have any sort of real estate within your business, well, there's certain entities that work better than others. The old rule of thumb was always try to keep property out of a tax-paying C corporation. It just gets trickier once you start buying and selling and eventually selling the business and maybe even transferring those assets out of the business. When you start looking at passing down generations, estate planning, really difficult to get real estate in and out without paying some sort of penalty. So that is a very first question we ask is, well, do you intend to hold any real estate within this entity? We may want to strongly consider this versus that. It's not a one size fits all. You may have a situation that works better for you or something that really points you this direction. But real estate is a really important thing to consider. And then what are our income tax rates? Those change all the time. Unfortunately, they change based on who's in charge, who has control of the House and Senate, and what they decided to hide in the back of a 11,000 page bill that we didn't know about till last minute. The rates change, unfortunately, every year, just about. Most of the time, slightly. You don't even know, it doesn't impact you. But sometimes, like 5 years ago, they changed a lot. And when they change a lot, when they really change the corporate rates from 35% to 21%, well, we got to reevaluate everything. When they change deductions and what is depreciable, what can you write off, what can we take as far as meals and entertainment? Well, I used to tell you every time you're going to do this, but no, the game has changed on us a little bit. The tax laws changed, the rates have changed, some deduction has changed, and now we're really recommending you to do this instead. So everything gets reevaluated, and you can change business entities pretty easily a lot of the times. So it's not like you're going to be stuck there forever. So your entity structure can change, especially if you're going to have ownership changes. And if you're going to take a lot of cash out of the business, well, there's easier ways to do that within some than other. As I mentioned earlier, I mean, if you're planning on taking cash out of a C corporation, you're going to get taxed on that. It's got to come to you as either a paycheck subject to tax or a distribution, a dividend subject to tax. So if you are planning on living on this business and not just accumulating income, earnings within it and growing it, if you're planning on taking withdrawals, well, it may make more sense to be an S Corp versus a C corporation, or be a partnership versus something else. Are we to yours yet?
I think we are.
Oh, good. I can take a break for a second.
All right, so once you decided what kind of entity you're gonna be and you started your business, you gotta figure out how you're gonna track your income and your expenses. It's really important to do that. Of course, we have lots of clients that bring us their bank statements in the year and go, I don't know, here's what I did. And they
Yeah,
figure
shoe
it out.
boxes.
Yeah, shoe boxes, and it still happens. But we prefer that you try to do that ahead of time and have some sort of record keeping put in place to make that happen. So there are a lot of ways to do that. If you're small, you're just getting started, you don't have a lot of transactions, Excel works great. I mean, just set up some sort of thing that flows through, reconcile your bank statements, those kind of things. But Excel works great. If you get busy, you have a lot of activity, and you have a lot of categories of expenses, and you want to track something, you want to be able to run reports easily, something like QuickBooks is great. There are a lot of other software out there other than QuickBooks, and I will say QuickBooks has decided lately to become very expensive.
Yep.
Their desktop version, you used to be able to buy it, and if you run payroll, you could keep one version of it for 3 years. They now have a subscription base every year. You have to redo it every year, so they're really becoming costly. So that's why I encourage it, until you're really busy, try to keep track of it somewhere simpler. There are other software out there. There's a lot of things coming out. There's some other things that you can use other than QuickBooks. QuickBooks is just the one that most people are familiar with. There is a desktop version and an online version. A lot of people are going to the online version now. It does have a lot of apps that you can interface with, and a lot of things you can do on your phone with an app and different things, and it works great. From accountant's perspectives, it's not our favorite thing. We have a hard time helping people clean up stuff, and QuickBooks Online desktop had some accounting versions that we could do some stuff with that helped.
Yeah.
But online is great. I have a lot of clients that use online version, and they can keep track of stuff. We can get online and look at stuff they're doing. So there's perks to both. It just kind of depends what you're doing. If you're out and about and you want to be able to have access to it, look at it anywhere you are, the online version works good for that.
And QuickBooks is not great for nonprofits. It's actually really, really terrible for nonprofits. And so many nonprofits use it because it is by far the most popular accounting software out there. It's probably also the most affordable. I mean, especially the online version. I mean, she'd mentioned for us, for our perspective, so we are helping clients do their bookkeeping a lot of times and helping them do their tax return and do their audits. And we get into their QuickBooks file, and the software is just a little more robust. It's easier to diagnose problems than the online. The online is fancy but limited, but it does give you that remote access. It's on your phone. But I know we have a lot of nonprofits, so QuickBooks for nonprofits stinks. It does. It's just unfortunate. It's not what they're made for, and there's really not a good, cheap, similar alternative to it.
Well, that's the one that goes into our donor software.
Yep.
That's our option for.
Integrates like Donor Perfect and yeah.
I have a couple clients that use something called Arise,
Mhm.
tax funds. Several that use that, and then one I've seen here lately quite a bit, but I don't mind talking to y'all.
Yeah. There's a lot of options out there for nonprofits. Some, I mean, are really small. And unfortunately what happens, what we see here in town is a lot use QuickBooks. And when you use QuickBooks as a nonprofit, there's just so much that is specific to nonprofit accounting that's different. It's required. You have to do it. It's more compliance. It's the only thing that will get you in trouble as a nonprofit is not acting like a nonprofit. So if you can't keep your books that specific way, following those standards and in compliance with the IRS and everything else, that could get you in trouble. And the biggest thing with a nonprofit is you have a responsibility to receive, track, and use donor gifts. And once you start going down that road, you're almost like a bank. I mean, you have that fiduciary responsibility to accept their money and use it for whatever legal purpose they told you had to use it for, whatever legal purpose you were set up to do. And if you don't, or even if you don't track it, and that's where QuickBooks fails, is that they don't track that well. They don't have the statements set up right. They don't have the sub-accounts modules to really help nonprofits. So what a lot I see do here in town is they use QuickBooks like a for-profit business. They use Excel for what they have to bridge the gap, and then they just end up kind of forcing their financial statements and making journal entries to make it work, because QuickBooks really can't get there unless you do some back-end accounting, and it gets really funky. You can do it, it's just difficult. And I know that's a frustration everyone has with them. So a lot of options out there, a lot of really big, robust, expensive options for nonprofits, but most end up kind of limping along on QuickBooks for as long as they can until they decide, yeah, I really want to spend the money and upgrade to something that is going to be a good nonprofit specific ERP accounting system for our business.
I do see a lot use the donor software on the side, some ways with QuickBooks, just with the donor piece, is the piece that just gets
Yeah.
out of hand quickly, so, yeah. But we can talk about payroll, so, or do it yourself, hire an employee to do it, outsource it. You know, there are a lot of options for payroll. You can use QuickBooks to do payroll. QuickBooks Online has a full service payroll option. You can use, we have payroll, we do payroll within our firm. There are a lot of online payroll services out there, but you just need to make sure if you're gonna do it, you know what you're doing and you make sure you do it right. We have a lot that do their own payroll, but then we do their quarterly payroll returns just to make sure that everything's been reported and deposits and paid correctly, all this kind of thing. So there are a lot of options, but if you're gonna have employees, just make sure you're paying your deposits on time. We're gonna talk about that a little bit more in a minute, and you know, the payroll returns and those kind of things. But there are a lot of online payroll services out there. Some, you know, these are, you know, the main thing I hear about outsourcing your payroll is that you, one, never had the same payroll rep for like more than a month. They change reps a lot, and you know, you just can't get a hold of anybody. It's one complaint I hear about ADP is they just can't get a hold of people to talk to them about your problems. So there's options, and some of them are cheaper than others, but you're going to get what you pay for. So
Dozens of options out there,
yes,
even that are pretty close here in
Yeah.
East Texas that we work with that have representatives here in the community.
yeah, so there are a lot of options. So if you
Yep.
need help with payroll, if you just want somebody to talk to you about options, don't mind doing that with
And
you.
payroll could even be yourself. So you really need to keep in mind, if I'm going to start having employees of my business, you can get in trouble pretty quick not keeping up with your payroll responsibilities of filing and remitting all the taxes that have to be withheld and filing your payroll tax reports and quarterly filings. That can get you in trouble pretty quick, and there's some penalties and interest there. But even yourself, if you set up one of these different types of businesses, like a C corporation, absolutely, you're going to be an employee. Even an S corporation, which we think, well, an S corporation just kind of flows to me. A big distinction with an S corporation is that you are an employee. So as an owner, even as a single owner of an S corporation, you're an employee, and you have to pay yourself as an employee owner and start paying a paycheck with tax withholdings and sending that money in regularly to the government throughout the year and filing all your quarterly payroll tax filings if you select that entity type. And there's a lot of those little nuances in between, but that's just something to keep in mind, that I may have a responsibility even to myself within a certain legal entity structure to pay payroll, which no one wants to do. And a lot of times what happens is they don't know it. We come in and we say, hey, you're supposed to be paying yourself a paycheck, and they engage us to do that for them because it's a pain. It is a weekly, monthly, quarterly event that you really have to keep up with. And when you're in the business of construction or retail or whatever it is, you don't really care about accounting and care about payroll tax filings. So we help in that respect when we can, but when you don't know the rules, it's hard. And really that's why we're here to help, is kind of let you know, hey, go out there and check on these due dates, check on your responsibilities, and even if you don't know what to do, you know that you have to do something and know that I need to go research it, find someone to ask, so you are keeping up and you're not getting in trouble, getting late with the IRS there.
And we're here to answer those questions. I mean,
Yeah.
That's what we do. We may not do your payroll, but I may tell you, you gotta go get an EFTPS account, you gotta get a TWC account,
Yep.
you gotta file these returns, and try to help you get it set up. But, you know, we're here to help with those questions.
No. And as a
There we go.
business that has employees, it's always a really fine line is, hey, I'm hiring someone to do work in my business. Are they an employee of my business or are they an independent contractor? Big difference from your perspective. If they're an independent contractor, you can just send them a 1099 for everything you paid them during the year. You don't withhold taxes. You don't have to pay them a paycheck with federal income taxes, Social Security, Medicare withheld. You pay them gross. You pay them $100, you give them $100. And then you give them a 1099 at the end of the year that says I paid you $100. You also give the IRS a copy of that. Well, the limit's $600, so $100 was a bad example. But if you paid anyone over $600 as an independent contractor, you're supposed to give them that 1099, and you're telling the IRS, hey, I paid this person over $600, so look for it on their return. Once you have your own business, though, and you start retaining services of others, you really need to look at the rules of, am I employing this person? Do they only work for me and I am telling them when to work, what to work on? I'm giving them the resources to do that. Well, they're an employee. Or is this an independent person business that I've just hired as a contractor to come in and do one specific task, job, ad hoc project, but they're really not an employee of my business? I know the IRS has gotten a lot more aggressive with that. Everything, even within school districts now, they've tried to convert everyone to W-2 because if it looks like they're an employee, IRS is going to say they're an employee, and that burden is on the employer. It's on you as business owners to make that determination and to file all those payroll taxes appropriately, and the penalty is going to be on you to pay. Man, we're scary stuff here. We need to lighten this up.
When you do hire an employee, you need to get W-4, you need to fill out an I-9 for them, and new hire reporting. New hire reporting is very important. That's how the state tracks down people for child support purposes. And that's true whether you hire contractors or employees.
Yeah.
So you're supposed to report new hires, however they are, that's how they find them to start collecting child support. So those things are all important. You have timelines you have to do those within. W-4 tells you how to withhold taxes. Yes.
I'm sorry, do we do a new hire reporting if it's an independent contractor or something?
Should, you're supposed to.
Okay, where would we find a new hire reporting form?
On the state of Texas, it's under the child support.
Yeah.
Attorney General?
Yeah.
One of those state
Attorney
agencies.
General, Attorney General.
If you look on the state website, there's a drop down that sends you that direction.
If you use QuickBooks or anything, they do have that in there, so
And that's kind of a new thing. It's always been the rule, but it's really a focus now
it is.
to find those individuals so they can't skirt their responsibilities and the money that's supposed to be coming out of their paycheck for child support, alimony.
Yeah.
So your W-4 is your new hire paperwork. If you have an employee that gives you their information, name, address, social security number, and their election saying this is how much tax I want you to withhold from my paycheck. Your I-9 is the same form, but that's for your independent contractors that we're going to pay a 1099, not a W-2, and that gets the same information for you that you need to collect: name, social security number, or EIN if it's a business.
The I-9 also helps you determine that they're really qualified to work here in the United States. That's what that's for, is the I-9 verification, so make sure they're really a legal citizen or have some sort of classification to be able to work.
The new hire reporting is separate from both of those.
Yeah, those are all three different things. So, all of these things, they change as your business grows. So like I said, you might start with Excel and then need QuickBooks or some other software, but you might not have employees, but then as you grow, you do need employees. So you're always needing to reevaluate these things because they will change as you go along. Cash or accrual, this is always a fun topic. So cash means, you're tracking your income as the money comes in the door, and you're tracking your expenses as you pay them out. That's cash. Accrual is if you're, sending out invoices and you're going to determine, you're tracking how much people owe you, or you're putting bills in the system that maybe you're paying later. Those are accruals. So you're tracking in how much you owe out, how much you owe to other people, and how much people owe you. And so you make a determination of that on your taxes, whether you're going to be in a cash or accrual basis business, and so you have to know that how you file that when you signed up to get your SS4 with the IRS. You're going to determine whether you're cash or accrual. And so it does determine how you set up your software, how you set up your reporting. But most people are cash basis. I mean, certainly
Yep.
most small businesses are cash basis. The pool is really usually typically larger businesses. But cash is easier. It's always easier to know this much came in the door, this much went out, and how much I have left. So that's just a simpler way to look at cash for approval. So.
And nonprofits have to make that determination as well. If their very first filing is a first year 990 tax return, they'd mark it at the top and like cash or accrual. Even if you're a Schedule C business and it's on your personal return, you have to mark cash or accrual. Majority of small businesses are going to be cash. I'd say majority of nonprofits are going to be accrual. They're not a tax-paying entity. Normally you would pick cash because you want to match it with your cash receipts and cash outflows, and you know what you're going to pay in tax, and you want to have that money available. On an accrual basis, you may have reportable income that you haven't received the cash yet, but if you report it to the IRS, you have to pay tax on it. So it'd be a bad situation to get into if that's just kind of the way it lined up at your end. Is I've sent a lot of bills to my customers, I haven't collected their money yet, I don't have the cash, but if I report it on my income tax return, it's accrual basis, it's income, it's taxable income, and I'm paying tax on that, which is why most pick cash basis. They want to know it's a checkbook. It's cash in, cash out. Here's my net in a day. That's my income. That's what I owe tax on. Most nonprofits and most corporations are accrual. And the key differences there are just your payables, receivables. It's when you are due it and when you owe it. So if you hired a plumber to come in on the last day of December to fix the pipe, they may not bill you until January, but you receive that service on that date. That's when you got the benefit. So on the accrual basis, that's an expense to you. And we would actually record that as a payable and expense because we know we incurred the benefit on this date, or vice versa. If we are the plumber and we perform the service on that date, that would be a receivable to us. We've earned that income. We did our job, even though I may not create the invoice and send it till a couple weeks, couple months later. We're matching it when the period of service and benefit is, not when the cash inflow outflow occurred. We could talk an hour on cash accrual if we wanted to, which I would be thrilled to talk about. But
IRS audits, no one likes to get any correspondence from the IRS. That's just, you get that in your mailbox and you go,
yeah.
I still do a little bit myself. I'm not scared of it as much. But the main thing is if you get any type of audit, you want to have good records. I mean, that's the whole thing. If you've got good records, you can support everything you've done, everything you've reported to on your tax return, you've got receipts and you've got all those things.
Yep.
You don't have to worry about it. I mean, if you've got, if you can back up what you've reported, then you're okay. So that's why record keeping is so important. So.
And typically keep those records for a period of about 7 years is a general rule. Can be longer. I mean, there's no statute limitation of time. If the IRS suspects fraud, they can go back forever. But just a general rule of thumb is keep all your records for at least 3 years. 7 years is ideal. Typically, we tell people 7 years. And the way the IRS contacts you, and not all communication is an audit. So a lot of people get IRS communications in the form of a notice. It's very common. They will almost always and only communicate to you through mail. If you get a phone call saying you owe money, it's probably a scam. They're not going to call you. They're not going to email you. They're going to send you an official letter in the mail. And even now, I'm starting to see some fake letters in the mail too, that clients scan us and say, hey, is this real? Like, well, do you think you owe that? Like, this doesn't make sense to your business. Let's look into it. We can always call the IRS and go over your account, or you can call the IRS. Good luck right now. You'll sit on hold for about 4 hours. Hopefully these new 80,000 agents they're hiring will help with that. But the IRS will only communicate with you initially, at least, over the mail. So you will get a paper letter in the mail. Don't be fooled by phone calls, voicemail saying, call us back, you owe all this money. It will come in the mail.
I just recently, my father-in-law, I helped him with his tax return. He has no income whatsoever, but we filed his tax return, sent it in. He got a letter back from the IRS saying he needed to verify his identity. So that's a new thing they're doing also.
Yeah.
So I had to actually go up there because I had to scan in a picture of his driver's license and I had to take a picture of him then I guess their computers matched up the pictures and verified, but I mean, it was quite the process to go through and do
Yep.
that. He didn't do anything wrong, he thought we had surely done something wrong in his tax return, and, well, I used to have it, I know you used to, it's just a random, I told him it's kind of like going through the security at the airport.
Yep.
And randomly, someone gets pulled over, not because you look like you were something bad, it just randomly chose you. He was just freaked out that he had done something wrong and they were after him, so, no, we're fine.
Or it could have been because the business itself had some sort of fraud occur, or not fraud, but theft. We get those emails all the time from these various companies like PayPal. Hey, your identity may or may not have been stolen recently. I get those a lot, and most of the time we ignore them. But if the IRS knows that you had an account with one of these companies that was hacked, they may go ahead and put in an additional safeguard to make sure it is you that is filing this tax return, because they want to make sure that you're actually getting or paying the money that is just related to you and you're not getting spammed. So they may send you a notice to say, hey, will you verify this? And you can do that pretty easily, but it's a pain, unfortunately. And you didn't do anything wrong. And that's what I was going to say. Not all notices are bad. We see 99% of the IRS communication that we get for our clients, it's a notice, it's not an audit. There's not a whole lot of audits going on. I mean, random audits still happen. They're trying to get more specific, though, and not audit us individuals. They're not auditing your church donations to try to verify if they're right, to get them a couple more dollars in taxable income. They're after the big ticket companies and the very aggressive deductions and more risky red flag areas of those complex tax returns that are subject to a little more complexity and just judgment than an individual tax return. I've not heard an audit of a standalone individual tax return in a couple of years now. I don't think they're doing as many of those just random audits anymore of people. It's more specific to, oh, this company claimed this deduction, we're going to audit that, and then the people involved, they may get audited as well. But notices, it can be anything. It could be you entered a number wrong, a address wrong, a name wrong, and they're trying to verify that for you because all they know is this was the information that you filed in your return. Is it right? Or they may come back and say, hey, you actually owe us all this money because someone submitted a 1099 to us saying they paid you $10,000 during the year and we don't see that on your return. It may be there. It may be in a different place, or it may have been netted against expenses, and now the burden is on you or you working with your CPA to get in contact with the IRS and prove that, no, it was there appropriately and this is why you don't see it. But it's just majority of the time a computer generated check of, we know you got all this, we didn't see it where we thought we would see it, here's your notice, you owe us a bunch of money, and now it's up to you in their defined time period to figure that out, unfortunately. So notices happen a lot more than audits, and probably a lot more than they used to happen. But notices aren't always bad. Could be in your favor.
We've talked a little bit about payroll, but just want to kind of go over a couple things. Payroll tax deposits, so that amount that you withhold from an employee's check, and then your match on that, that should be paid in. It depends on the size of your payroll, how often that needs to be done. So you might be a semi-monthly payer or a semi-weekly payer, or you might have to pay it monthly. It just depends, and that you need to reevaluate that every year to see if you've changed into what category, and the due dates as to when your tax deposits are due are based upon that schedule. So if you're a semi-monthly depositor, if you make your payroll on Tuesday, then they're going to tell you what day you need to make your tax deposit. And so those are things that you will get penalized for when you file your quarterly returns. If they come back and realize that you did not pay your deposit on time, they will penalize you for a late payment. So that is something that will happen. So you just need to make sure that you check that and know exactly when you're supposed to be paying. Like I said, don't be late. And then your quarterly and annual filings that you have to do. A 941 is due quarterly to the IRS. That's where you tell them what your tax deposits should have been, what your tax deposits were, and if you're large enough, you have to tell them when those tax deposits were due, and then they're going to go back and match that up to your payments to make sure that you pay on time. And that's, you may get a notice about something about that. Texas Workforce Commission, you have to file a quarterly return within and pay in, and it's a percentage of wages up to a certain amount. So, and everybody's percentage will change based upon how many claims you have with the Workforce Commission. If you have a lot of unemployment that gets filed, your rates will go up. So you start with the base rate and it will fluctuate every year, and you need to make sure you keep track of what your new rate is. But you do have to file a quarterly return and make a quarterly payment with them for that. A 940 is for federal unemployment. That's filed once a year. You can make your payments through the year, but you only file the 940 one time a year. And again, it's a percentage, and it's got a max for each employee on that. And then the W-2 is what you give your employees every year. So you need to make sure you give those out by the end of January. You file a W-3 with the Social Security Administration. And then all of those things, the government, the Social Security Administration, IRS, will go back at some point and match up your 941, your 940, and your W-3 and make sure all those things tie together. And if not, they're going to send you a notice that says something's not quite right, you know, where we need to correct. And so that happens. It's okay, it can be fixed, it's nothing to be alarmed about, but they do go back and make sure all those pieces tie together, so.
And there is going to be a quiz at the end of all these different names, numbers, abbreviations, due dates. Yes. You may be a CPA by the time we leave.
All right. Okay, so I want to spend just a minute on payments to contractors and 1099s. This has become the hot topic with the IRS. They are high on the 1099s. So 1099, if you've hired an independent contractor that you decided is not an employee, and this could be anybody you hired to do a service for you. So if you had your plumbing repaired and you paid them over $600 and they are not a corporation, you need to give them a 1099. So anybody that provides a service to you needs to get a 1099. This is something that a lot of people don't understand.
Yeah.
But like I said, it's become the IRS's hot topic. And so we've been doing a lot more work on 1099s and trying to educate a little bit. But anybody that you provide a service to, our number one thing we say is to get a W-9 from them. It's a form that they fill out that gives you their tax ID number, their address, and tells you what kind of entity that they are. And we always tell people, get that from them before you give them the check, because once you give them the check, they may or may not want to give you a W-9. That is how people avoid having to pay tax on it.
People don't want 1099s from you because they know a copy of it goes to the IRS and then they have to report that as taxable income, which is the whole purpose of it.
Yeah, so if you're going to claim it as an expense on your return, it needs to be income on somebody else's. It's like what the IRS is trying to match up. And so if you don't get that W-9 up front, you may have a hard time getting that later on. So we always recommend getting a W-9 first. But just want to go over just a few basic things about 1099s. If you are engaged in a trader business and you hire anybody to provide a service, you need to give them a 1099. That's for services, but there's also 1099s for rent. If you pay rent to anybody, you need to give them a 1099. There's a lot of different ways you get 1099s. So nonprofits have to do this. Trust and qualified pension plans have to do this. So there's really nobody exempt from doing this. You have to file your 1099s. So any person that you pay a vendor, subcontractor, independent contractor, if you pay them more than $600 a year, you give them, and they changed this a couple years ago, a 1099 NEC, which is a non-employee compensation. So it used to just be one form 1099. They broke it out a couple years ago, 1099 NEC. So if you give anybody, pay anybody for any type of service, they get that form. Now, if you pay for rent, you give out prizes or awards, or you make health care payments as a business to anybody. There's some fisherman things in there. Those are 1099 miscellaneous. Same thing, over $600. You have to give a 1099 miscellaneous. Not even any questions so far.
Lots of questions on that, I know. And if you're not sure, do it. Because really the penalty is on you as the business owner if you don't. So the reason why you wouldn't have to is because whoever you paid is a incorporated business. So if you're hiring professional service companies, the majority of the time, and if you're hiring CPAs, others, attorneys, they're going to be professional corporations set up or some sort of corporation to where you don't have to 1099 them, but you may not necessarily know that. It gets really confusing. So that's why you ask those questions. And even if you suspect, and there's ways you can go online and really check their tax status of that entity, but if you suspect, that the tree trimming person I hired is telling me I don't have to give them a 1099, and you just kind of cock your head like, yeah, I don't know. I paid them cash, and this seems like I may need to do it. It doesn't hurt them, but you have to, and it can hurt you if you don't. It is their responsibility, regardless if you pay them $1 or $1,000 to report that income on their tax return. Doesn't matter if you appropriately or inappropriately send them a 1099 or not. If you were supposed to and don't, it is their responsibility to claim that money. So you should never hurt them by sending them a 1099 because they have to claim that income regardless. But it can hurt you if you don't do it. But if you send one and someone didn't need it, it happens to us all the time, we throw them in the trash. So it's no big deal. Like if people get a 1099 that didn't need one because of the type of entity they just shred it. They don't need it. The IRS is already, they have all this information. But if you didn't send it and you were found to have supposed to have sent it, there are pretty big penalties there.
Yeah, they're now penalizing from $50 to $560 per 1099 for either not filing them late, or not having all the information. So we've had clients that have gotten, and they're now looking back 3 years. So
Yep.
we're now finding issues from 3 years ago. But we've had clients that've gotten bills from ours for over $100,000 because of 1099 issues. Now, there are large companies that file a lot of 1099s and they file them later. They didn't have
Yeah,
all
or
the-
didn't file out
didn't
1099s.
file. But it has become a steep penalty.
Yeah.
Now, one thing I wanted to say, if you pay somebody with a credit card, or you Venmo them, or you pay them by PayPal, Cash App, any of those Cash App, you do not have to give them a 1099, but if you pay them by check or by cash, you do. So
Yep.
credit card companies and Venmo and PayPal, they're supposed to take care of those 1099s for you. I have a client I was just talking to the other day that pays a lot of people he runs baseball tournaments, and he pays a lot of people, and he pays them all by Venmo. I said, well,
Yep.
you're good. Keep paying them by Venmo. So
Even
thank you from the top.
eBay now, I've heard, is sending 1099s to people doing business through eBay.
Now,
So
how they do that, I don't know how Venmo and PayPal and Cash App keep track of that. That's their problem.
Yeah.
But as for your purposes, if you're paying them that way, you don't have to send them
Yep.
1099s, so it does save you. So 1099s are due to the recipients and the IRS by the end of by the end of January.
Yep.
So just make sure you're not late, because like I said, they're sticking to those rules. Yes.
So is it a debit card, is that the same? Or is that
Debit card is come out of your bank account.
Yeah, it's same as cash.
So, yeah, credit card only, so, yeah.
Yep. Debit card, cash, check, really need to do a 1099. Due by end of January. You can get these for free if you need copies from the IRS. You can't download them from the IRS website, but if you go online even today and say however many you need, they will mail hard copies to you. CPAs also keep them. We have thousands, if not tens of thousands. We file some paper, we file some electronically through our software. There's also hundreds of companies online that will file them electronically for you for a small fee. But you can get the paper copy for free. The IRS will mail them to you, everything you need.
But you don't, if you're, personally, you don't have to file 1099s if you pay something from your household. Don't get confused with that. If you bring in somebody to clean your house, you don't have to give them a 1099 for that purposes. So, businesses only, yes.
I'm sorry, what about the W-9s? Are they online as well?
Yes, you can
Yeah.
You can download
Can't
that.
find it for the life of me. But they're on there.
I'll give you my card, you email me, I'll send you one.
Wonderful.
Yeah, no problem, no problem, yes.
Yeah, most tax forms, you can at least find the paper copy online on the IRS or some other state website to download and print. But it'll give you a warning, like a 1099, you can pull it up, but it will have this big warning on it that says, do not print or it will not be accepted. So you can't just pull it up and print. You have to actually have them mailed to you because there's barcodes and they all kind of match each other. But the W-9 you can. That is one. W-4 or the I-9, all those you can go on and print.
Yeah, the official tax form stuff. So the 1099s that you send to the IRS, you have to send with the 1096, which is a summary of all your 1099s. That goes to the IRS by the end of January. But just want to talk about that because it's confusing. I used to work in industry and thought I understood 1099 until I worked with Henry Peters and went, I really didn't get it. Now I get it. So there's a lot to it. There's a
Confusing
lot
and very important. I mean, it is a hot topic right now with the IRS.
So, anytime you have questions, feel free to let me know. So, all right.
Okay, back to me.
Yes.
So a couple other just high-level tax topics, and we'll touch just briefly on audits. I know some of y'all nonprofits, you may hear that audit word, so we'll talk a little bit about that. Then we'll save a little bit of time for questions if we can. From a tax perspective, so you may have a responsibility even beyond your annual tax filing to pay and file quarterly. So especially as self-employed individuals and as sole proprietors, the government wants their money and they want it as soon as possible. So when you are an employee of another company and you are getting regular paychecks and at the end of the year you get a W-2, you are sending in money every paycheck and your company is withholding money from your check and sending it in regularly, weekly, bi-weekly, monthly. They're sending in your tax money to the government. When you're not an employee, when you're a self-employed individual and especially a sole proprietor, you're not sending in any money. You're only calculating what you owe in tax at the end of the year when you file your tax return. Well, the government doesn't like that because they want their money sooner. So what they make you do is make quarterly estimated payments on how much tax you are going to owe come the end of the year. So you have to estimate and figure out this is going to be my tax liability and really divide that by 4 and pay that in quarterly. So that is the way the government gets their money sooner than 12 months, 18 months when a tax return is due. They make you pay it in April, June, September, and January, I believe, are the 4 quarterly dates right now. So they don't follow what you would think of, but those are the 4 quarterly dates to make those payments. You can do that online. You can easily set up an account, direct deposit, or there's vouchers that you can download and mail in as well. But that is paying in your estimated tax for your small business throughout the year, not just when you file your return. If you wait, and a lot of people decide to wait, even when we give them that warning, you may and probably will be subject to some underpayment and not timely filing penalties and interest. How much those are kind of depends on how much you owe in tax. A lot of people will say, you know, I don't have the cash right now. I know coming into the year, I'm going to owe $20,000 in tax, but it is more important to me today to keep my $20,000 in cash to run my business. And I'm just going to accept that come April, when my tax return is due, which is when your tax is due, regardless if you extend or not, I'm going to have to pay in that full $20,000 plus a little bit of penalties and interest. They make that decision for their business, but at least they have the information of, hey, this is when it's due, or else you may be subject to some penalties. State taxes, if you do business, so if you have sales in any other states, even online sales now, which is kind of the new thing, you may have a responsibility to file a tax return in that state. The state of Texas does not have personal income tax and personal tax returns, which is why we all live here and enjoy living here. We don't have state income tax. We pay a lot of property tax, but a lot of other states, the majority of other states, do have state income tax. And if you make business sales in those states, doesn't matter if you've never stepped foot there, you may have to file a tax return in those states, especially our neighboring states here, Louisiana, Oklahoma. So keep that in mind once you start making online internet sales. Used to, the rules were pretty easy. It was physical nexus. If you had people, payroll, or places in another state, you had to file a return. It's really switched in recent years to economic nexus, and every state has its own rule of if you have e-commerce, internet sales of over a certain dollar amount or number of transactions as a business, you have to file a return in that state. Something to keep in mind as individuals and self-employed individuals as well. And even Texas now, as of not too long ago, about 10 years ago, does have a state tax return requirement, but it is only for businesses, called a Texas franchise return. You do not owe tax if you have revenue less than $1 million. If you're over $1 million, you may owe some tax. But even if you're under that, as a corporation, as a business, you may have to file a Texas franchise return. And that even applies to LLCs in a lot of situations. So if you establish an LLC for liability protection, and that LLC is just going to you and only you on your personal tax return on a Schedule C, you may still have to file a Texas franchise return. You're not going to owe any money most likely, and unless you're really making millions of dollars on your self-business, which is great. But you do have to file that, or else you're going to get a notice that they're expecting a return and you didn't file it, and now you owe penalties when you do file it. So Texas franchise filing for businesses in Texas, we do not have a Texas personal income tax or filing requirement, but a lot of other states do. And some business deductions here that are pretty common. So auto expenses, so this is using your vehicle for business, or if you bought a business vehicle to exclusively use in that business, is deductible. And there's two different ways to do that. You can take your actual expenses of that vehicle and gas, oil changes, maintain it, or you can keep a mileage log. And there is a standard IRS mileage reimbursement rate out there that we can use that's pretty generous. It's more than the cost of gas. It's supposed to cover some depreciation, wear and tear as well. Most people keep a log of here's how many miles I drove this year for business that I'm going to claim as a deduction. Here's how many miles I drove in total. The rest are personal to me, not deductible. Home office, if you do have a dedicated space in your home that you are using exclusively for your business, you can deduct that. So this cannot be if you're an employee of another company and you get a W-2, but you work from home, that doesn't count, unfortunately. I know that's impacted a whole lot of people last couple of years. This is, you have your own business, you are self-employed, and you are using a dedicated space in your house. It can be, and even if you have converted the dining room or a home office or a nook, let's calculate that square footage, and we can either take the safe harbor rule here of $5 per square foot for a max of 300 square feet as that office space, that's our deduction, or we can take actual expenses, which can be anything and everything, your property taxes, interest on your home mortgage, utilities, your internet, and divide it by, if my home office is 300 square feet and my total house is 2,000 square feet, this is how much I get to deduct as a home office expense towards my small business. And then buying assets, when do you write off or when do you depreciate? So a huge advantage of businesses is the write-off of buying assets, and a lot of times that's vehicles. It's very common, at the end of the year, we get phone calls of, hey, how much am I going to owe in tax? I think I'm going to go buy an $80,000 truck to write it off. Because trucks cost $80,000 now. Like, okay, you can do that, and you're right. You probably can write that off and take an $80,000 deduction on your return. And it will offset $80,000 of taxable business income, but not always the best idea if you didn't need that truck, if you didn't need that asset, didn't need that vehicle piece of equipment to go and spend $80,000 cash to save whatever tax rates are today, which are a whole lot less than 50%. So it's always weighing that balance of, well, I'm gonna have to spend this much to save this much, and do I really need it? If you need it and you were gonna buy it the first week in January, absolutely. Consider buying that a week earlier, and we can look at, do you want to write it off? But we have the ability right now, and that changes every year, how much we can write off, if anything, 50%, 100%, depending on the tax law that year. But right now, most businesses can write off 100% of the purchase of that asset in year one. So if you bought an $80,000 vehicle as of 12/31, you probably have the ability to write off a full $80,000 to offset your taxable income, or you always have the option to depreciate and take that expense deduction over a number of years, over the useful life of that vehicle, maybe 3 years, maybe 5 years, and I'm gonna spread this expense out instead of taking it all one time. What a lot of people don't put together is, oh, I'm gonna go buy that $80,000 vehicle, but instead of cash, I'm gonna take out a loan. So I didn't have to spend $80,000 in cash. I took out a loan for that full 80, but I got my write-off. I cheated the system. Yes, I'm the smartest person ever. That is awesome in year one, terrible in year two, because now for the next 5 years or probably 6 or 7 years that you're paying on that loan, you have cash coming out every month that you cannot write off because you wrote off the full value of that to offset last year's tax and the year before and the year before. So for the next life of that loan, you can take no deduction for the cash that is leaving your business, which is a terrible position to be in because you really want to match your cash with your tax liability, because you may be draining your business of cash paying on that vehicle loan, and now you don't have your money to pay your tax bill because you're not offsetting your taxable income with that vehicle. So if that's the situation you're in, we really recommend, well, let's spread this out close to the term of that loan. That way your expense deductions are matching your cash outflows a little better, and we didn't just front load it and now you got all this income the next year with no expense to offset it. Big complaint people run into of, I don't have any cash, how do I have taxable income? It's like, well, you have taxable income because 5 years in a row you bought a new vehicle and you depreciated it. So if you keep doing that every year, it works, but the time you stop doing that, you're kind of in a bad situation. Retirement plans. Briefly, we'll talk about retirement plans. There's a lot of options out there, retirement plans for small businesses. I mean, the most common that everyone knows is a 401k. Most businesses have a 401k for their employees. You can set up a 401k for a small business individually. You can set up an IRA. IRAs, you're limited on how much you can contribute every year, and it's a pretty low limit. It's about $5,000. 401k, you can put in much more than that. So if you have an employer-sponsored 401k plan, you can put in about $20,000 or more in any given year. So big difference there. With the rest of them, it's kind of the same. They all have their own specific rules for how much you can contribute. A SEP, so a self-employed plan, or a simple, which is really set up for self-employed individuals or small businesses. They have their own limits, and most of the time they are subject to how much income, taxable income that business has. But if you have taxable income, you may be able to, with a SEP or a simple or a sole 401k, to contribute up to $20,000 or sometimes even $50,000 to that tax-free retirement account every year that's going to grow for your retirement benefit, which is great. And then Roth IRA is within all of these options. Roth is just post-tax instead of pre-tax, which is what a traditional IRA is. So instead of making a tax-free or tax-deferred contribution now to your account, you're going to pay the tax now and you're going to take it out tax-free later when you retire. Tracking basis in your business is very important to know how much money you put in, how much you've taken out. So whenever you sell that business or have a loss, we can only, in most cases, deduct that loss to the extent of your basis. So if you put in a lot of money up front, in certain years made money, lost money, this year we have a big loss, well, we can probably only take that loss to the extent that you still have basis. Or when you go to sell it, we need to know how much you have invested in that business. What is it worth to you? QBI, qualified business deduction. This was a new thing that came up several years ago, to where most businesses, even those that are sole proprietor businesses filing on your return, you can get this automatic 20% deduction on your return. So off of your income, expenses, your net income of that business, we're just going to take 20% off as a deduction if you are actively participating in that business. That is your sole source of income, or you're a professional in that industry. And then year-end tax planning is very important. Talk to your accountant, talk to your CPA, do some planning, figure out how much you think you're going to owe, how much you have owed. Is there anything that we can do now, such as putting money into one of these plans? You may have to do that before the end of the year. You may be able to do that through April 15th or even the extension deadline and still get credit for those deductions. Or you may want to go out and, instead of January 1st, buy that truck on December 31st, take that deduction now. But if you don't look at it in December at the end of the year, you're going to miss out on that timing, because if it doesn't happen, you can't take credit for it and you're going to be stuck with whatever you owe. High level on audit and attest services. So I do a lot of these, and the one word that everybody knows, and especially nonprofits, we get calls all the time from nonprofits saying, hey, we need an audit. Because it's the only word that anybody knows is an audit. So I wanted to talk briefly on what an audit is and what else is out there that may fit better for your business to help you with what you need. So an audit has to be performed by a CPA or a CPA firm. It is highly regulated. There are industry standards and guides that have to be followed. And it is the highest level of third-party assurance that your business can get, that says, in accordance with the auditing standards, the CPA has signed off and given you a letter, an opinion, and report saying, yes, we agree or disagree that your books and records are in order in accordance with the basis of accounting that you picked, cash or accrual, tax or GAAP, generally accepted accounting principles. And you can take that, you can send it to anyone you want to, you can give it to a bank to get a loan, but an audit is the highest level of assurance you can get from a CPA. You don't always need an audit, and a lot of times an audit is not what you want, because really what you want is some consulting advice, and an audit can't do that because it is a independent third-party look of your financial statements, of your books and records, with the goal of giving an opinion to you, are your books and records accurate? It really can't help. It can't make significant changes, adjustments, make these accounting decisions for you of how to run your business. It is just a third-party look to say yes or no, good or bad. You have it, you take it, you run with it. A lot of time, nonprofit board members will get on a new board and say, when was the last time we did an audit? We need to do an audit. Well, why? And we get those calls. We have to kind of talk through them. It's like, well, why do you want an audit? Well, I want to make sure things are happening right. Okay, it may or may not help, but is there anything specific? Well, I'm really concerned about this area of receiving cash donations and recording them properly. Well, if that's the only area you're concerned about, an audit has to cover everything. It covers every single account you have, all of your processes, controls, people. It covers everything. We can't do an audit of just one. It covers it all. Maybe we can do something a little more specific, like agreed upon procedures or an internal exam, fraud exam, to look at what you really need help with. More in terms of consulting and guidance than an audit that's just going to tell you, yes, you did it bad, good or bad, but I can't really tell you really much of how to do it better. Maybe we need to do something different. Review is kind of a mini audit. It is an audit. It is independent. It is a sign off, yes or no. We did a good job, but it's not an audit. A review is performed, has to be performed by a CPA. It's going to be less in scope than an audit. It really involves inquiry, analytics, discussions, running a lot of trend ratios analysis to see, does everything look right? But it's really not getting into the detail, the weeds of vouch, verify, confirm, pulling invoices, support, contracts, checking off to make sure everything was done right. It's kind of a high level, but it gives you a little bit of assurance. And then a compilation is really below that. A compilation is a business may ask us as CPAs, hey, I need compiled financial statements. I need y'all to put my books into a normal format that a bank wants to see, or some granting organization, foundation. They're asking for financial statements and they want them to be compiled by a CPA. We all do that. It is limited to no assurance. We will look at it and just ask questions of, hey, your cash last year was $500 and this year it says negative $5 million. Is that right? But beyond that, it's really not going into the detail and verifying those numbers. It just may be high level asking questions, and it will say limited to no assurance whatsoever, but here is the format that the bank wants these in. We've compiled them for you. And the top one there, prepared financial statements. Prepared are, we may keep your books and the bank wants a copy of financial statements and we will go in and print. And that's bookkeeping. We're helping you keep your books through a bookkeeping. It's not a test, audit, review, or you may keep your books and you need us to get into your QuickBooks software and just prepare financial statements. So it's not even to the extent of a compilation, which we're going to make look like financial statements you'd get with a review and an audit. It's going to look like the format that they want nonprofit financial statements to be in. Prepared is going to be whatever you got. We're just going to go in and prepare them for you and print out of your system. Zero assurance. It may be right or wrong. These are the numbers you gave us, but here you go. We prepared them. So that's kind of what an audit is. An audit is not a fraud exam. It does not give you 100% assurance that everything is right. It does not look for fraud that occurred, even though as part of our procedures, we may come across it and make you aware. It's not looking at IT, security. There's a lot of kind of fringe benefits of an audit because those things get incorporated. And if we see anything that's off, we're bringing it to your attention. But really what an audit does is it is a sign off on your financial statement saying, yes, these are correct based on the procedures we did, based on everything that we were supposed to do. We vouched, we confirmed, we verified, we pulled all the detail, and we are signing off, giving a clean opinion that your financial statements are right. So only CPAs can do it. Audit cost, I mean, question marks all the way across. Depends on who it is, what it is, how big, how complex, just based on everything that's involved and the review and documentation. I mean, even your smallest of firms, which we're not, have a hard time doing any audit at all for less than a couple $1,000s. And then those fees can go up to, I mean, hundreds of thousands of dollars depending on the size of the company. So that doesn't really answer your question on how much does an audit cost. But what questions y'all have in the we have 5 minutes. 5 minutes is plenty of time. Because I think that was it. Yeah. Questions on audit, tax, general, bookkeeping, personal, unrelated, anything?
Not, you ready for your test?
Yeah, we'll pass out the quiz on acronyms and due dates.
I do that.
Yeah.
And I don't know what I'm doing, so you're probably gonna laugh at me.
No, I'm not.
All right, so in our small business, we don't pay ourselves yet, okay? And we're getting ready to. When that time comes, and we're writing, myself, I'm not gonna check. Are we 1099 people, or are we business owners, or are we payroll tax people?
Yeah, the first question is what kind of business are you?
We're in a soft wash, power washing business.
How are you set up with the
LLC.
LLC is a partnership of sole?
No, just sold for it.
Okay, so Schedule C, most likely.
Yes.
Okay, so you don't have to 1099 yourself. Some people do, and it's kind of interesting, but you don't have to 1099 yourself. And as a Schedule C, you wouldn't pay yourself a paycheck either. So you can take any money you want out of that business. So you are paying tax. Yep. With an LLC taxed as a Schedule C on your personal income tax return, which is probably what this is, you are paying tax on your net income of that business. So you're reporting all your income, you're reporting all your expenses, and whatever you have left in a day, you're paying tax on the net. You are free to take money out whenever you want. It is not reportable at that point. That is your money to do with what you please. Nope.
That's what I was afraid of.
It's already, you're paying, so as Schedule C, you're paying self-employment tax on net income and earnings, and that's how they get their Social Security, Medicare through that. It goes through the personal tax return. But that money is free to take out anytime.
Free.
Yeah.
Because you've already paid tax on it.
Yeah.
Is that like a bonus draw?
Yes. Exactly. Yeah. John, question? I thought I had a question.
I know it was a lot of like scary, do this, don't do this. If you don't do this, there'll be penalties. We should have put some more happy slides in there.
Yeah.
Running a business is great. Yeah.
Okay, so you guys talked or touched about the 990 for nonprofit.
Yeah.
Okay, so
The worst tax return there is.
that was like, don't forget, you may or may not have to do this. I'm
Yeah.
like, well, do I or?
So there are dollar amount thresholds for nonprofits that have to file at all, have to file just a one-page postcard 990 informational, can do a simple 990 easy, or have to do the full thing. And I forget those limits. I think it's like 2,500, 25,000, over 50,000, something like that. But that is on the IRS website. If your nonprofit has revenue over this dollar amount, you have to file this by typically May 15th is that first date. So it'll depend on how much revenue that nonprofit has.
It depends if your calendar year, fiscal year, so that's different.
Yes.
So, it's easier.
Yeah, the 990, if the nonprofit is at the highest threshold, I mean, I think like over 50,000 of having to file a full 990, it is the absolute worst tax return to do. Because even though it's not a tax-paying entity, it is dozens of pages of information about your nonprofit and all the income and expenses you had during the year, and even some donor information of large donations with their address, and it just gets
Your
crazy.
board members and
Yes,
the whole thing.
all your board members, if they get paid, their time spent, it's a very tedious return. It is a more detailed tax return than the largest tax-paying C corporation, which makes 0 sense.
We
But
have tax repairers that become 990 specialists just because everybody doesn't need to know all of that stuff.
yeah, very specialized tax returns. But a lot of times with a nonprofit at 990, the government doesn't know what your revenue is until they do know. So at that point, they start sending you notices, and if they find out, I mean, you could be subject to, hey, I needed to file this return 2 years ago, and you can always go back and amend for a certain number of years and And if you're a first-time offender, get out of any sort of assessed penalties and interest, most likely for failure to file. But you're not a normal business, and you normally don't have people sending you 1099s as a nonprofit, so the government doesn't know what your revenue is until you tell them. But if they happen to know because they audited someone that's involved or they get copies of it, you can get in trouble. Are we at time? Oh, we're at time. Thank you all for letting us come.